Hi, welcome everyone, and especially a very warm welcome to our fourth edition of the FINtastic Talk, and especially the first one in the new financial year 2021-22. New financial years are always very exciting for us because, we have a new year where we make resolutions about ourselves, and it is the new financial year where we make our new financial resolutions. So let the resolution for all in each and every one of us be for this year be that we have to create wealth. And wealth journey starts only when you start running the race. So, a lot of people are sitting on the side yards and they are waiting for this race to start. They are waiting to start their investment journey and they are never starting their investment journey. So, friends, unless you participate in a race, you can't win. And when you start running in the race, as they say, aim for the stars, at least you'll reach the moon. So it is very important for us to start this journey on wealth creation. So those of you who are investing, please keep investing. Don't be bothered about the absolute market or the absolute index value. We'll explain that today. And those who are waiting on the right side for the right time, there's never a right time. It is always the right time to enter the market as long as you do it systematically in a planned manner and you invest the right funds and the right stocks. And when you do that, even if you come in at the top of the market, you'll still have an opportunity to make money because there are always winners. And the whole aim of this is to help you find the winners. India has gone through a huge transformation, and one of the things we saw was lacking the investor education. And me as running one of India's largest wealth management firms, so although we have thousands of advisors who come and advise clients like you and other people who in their investment journey, but what we realize that for you to win in this journey, you need to have the basic knowledge and the basic fundamentals there, because only when you understand the fundamentals can you get a person to guide you. If you are too naive, then somebody will take you on the wrong path, and that's the most heartbreaking thing, that we know that if you remain invested in the market for 10 years, 98% of you will make money, but only 14 or 15% end up making money because they either panic, they move out, or somebody gives them wrong guidance or advice. So it is very, very important to build your fundamentals, for which we have launched a program called FINtastic. If you don't have the basics, do join this fantastic program. It is a 15-day program which teaches you right from budgeting, financial planning principle, goal prioritization, understanding why you want to invest, understanding equities, direct stocks, insurances, everything you need to do to to make yourself as a business or your investments like a business. And we have a very unique money back guarantee there, that you come join the program first week, if you don't like it, you can take your money back. There will be no questions asked, because our purpose is not to earn money from you, but our purpose is to get you started on your investment journey, get you started on becoming a path to becoming a crorepati through investments. Or if you're already a crorepati, then why not a billionaire through investments, or 100 crore through investments. So, and in this fantastic talks, I try to bring in people who I feel can add value to their journey. Before I talk about our speaker today, there's a very interesting book by James Cars, which is called The Finite and the Infinite Games. So it talks about one of the fundamental things it talks about is approaching life like a game. And they are finite games. They are games working towards a target or a goal. I want to achieve this goal and I want to do this. And there is an infinite game where we are playing the life as a game with no end in sight, but we are enjoying the journey. So both have their own advantages and disadvantages. But when you are playing an infinite game, when you want to enjoy every part of the moment, then learning and education is very, very important. And then you must keep upgrading yourself, because as you keep upgrading yourself, you keep becoming a better version of yourself. The life becomes more exciting because you start understanding more, and it's a much more interesting journey to be at. So guys, please do start playing some part of infinite games also. And today we are very, very pleased to have with us Sunil Singhania. He's one of India's most coveted fund managers. And we will talk to him about not only his investment philosophy, but his life journey. He has done tremendously well. He was the man who's one of the key cornerstones behind building Reliance Nippon Life AMC as one of India's best AMCs, known as one of India's best stock pickers, one of India's best value picker finders, one of the person who's able to identify the next generation of winners. And now in his new role, he's an entrepreneur. He started his own Abakkus mutual fund, Abakkus PMS fund management, and he's already reached 4,000 crores in assets, which is a fantastic achievement in the short time that he's done it. And let me welcome Sunil. And Sunil, it's great to have you. So my
Thank you for
first
having me,
question to
Ron.
you is that before we get into the investment journey or this, we want to understand Sunil Singhania as a person. So why don't you tell us a little bit about your childhood, your education, and that part of your life, and then we take it on from there.
Sure. No, thanks, Sanjiv, and very well said. Thanks everyone for joining in. Unfortunately, we are finance people and we are very boring people. So our life is not as enterprising as a sportsman or an actor would be. But I have been in Mumbai all my life. I have born and grown up in Mumbai. Though I am a Marwadi, from my ancestors are from Rajasthan, I was always in Mumbai. Studied in a convent, middle class background. My father was with the Birlas for 50 years. He was working with Birlas. And very, typical post-independence middle class family. Studied in a convent, joined college. Did not want to pursue the sciences field because my elder sister was a science student and I used to see her dissect earthworms and frogs, and it used to put me away. So I was very clear. I wanted to do something which was not science. And that time, Sanjeev, if you know, there were only two options. Either you pursue science or you pursue commerce. Arts typically was for girls, at that point of time. That was a very simple life. So I pursued commerce, and as every commerce student, I decided to take up CA. Luckily, I was a good student and became a chartered accountant with an all India rank very early in my life. I was only 20 years old. So in fact, I had to wait because the CA Institute does not give you the certificate till you are 21. So I had to wait for a few months to get my certificate. And, very logically, my uncle was a chartered accountant. So I started working with him as a practicing chartered accountant. One thing I just wanted to add, equity was always my interest. So even when I was in college with modest 500,000 rupees, I used to apply for IPOs. And I remember I got an allotment. That time it was a lottery. Even now it is, but that time more so. I got an allotment in a company called Godrej Gujarat Innovative Chemicals or something, And suddenly that 500 rupee became 5,000 rupees overnight. And it was a big kick, So frankly, the money gives you a higher kick than anything else. And I think that increased my interest in the equity markets. So even when I was practicing, I was always interested in equity markets. I used to read balance sheets even at that point of time. And though people find the balance sheets boring, it is something which I thoroughly enjoy. And I was anyway a voracious reader because, I was a little bit more academically inclined. So I practiced. I think the practice was good because it gave me a hands-on exposure to financials, to companies, to taxes. But heart was always in equity markets. So in mid-90s, when the economy started to open up, NSE came into being. And that time I got an opportunity because there was one rich gentleman who wanted to become an NSE broker, but he needed someone to give an exam because unless you pass the exam, you wouldn't get those coveted membership. And he thought that I was a smart kid, and he told me to give the exam on his behalf. I gave the exams, we got the card, and then he offered me to join the business. So I think I joined the business, or I would say I joined equity markets, which was more like, I would say, just it happened. And I think that was actually the start of my really becoming very interested in equity markets. I also then in 97 moved to a broker who was more institutional focused brokers. So most of our clients were foreign investors and mutual funds. That time mutual funds were small. And I think that period was actually the period where my research got really polished. And Sanjeev, very, very funnily, no one used to read balance sheets till maybe 5, 7 years back. And I think that created a sort of a vacant expressway. You had an expressway and no one was driving the car which you were sitting in. And it made things easy. But it was also a very difficult time. So the initial, after the dot-com boom, you had the worst recession between 2001 to 2003, where nothing was working, and stocks in India was so cheap. And when I used to go to my clients and present to them stock ideas, no one used to buy them at even 2p, 3p. And that time I decided that I want to become a buyer of stocks rather than hawking my ideas. So I was very clear I wanted to get onto the buy side. As I said, luckily most of my clients were mutual funds. So I reached out to Reliance. It was the smallest mutual fund, 35th out of 35 mutual fund. Total equity size was 35 crores. But Reliance always came out as an entrepreneur-driven organization, and there was this charm. And I joined. Madhu was already there. One thing which we believed that time, which we still continue to believe, is that India grows because of entrepreneurs and despite the government. And that is the stock we focused on. I think in 5 years, from being the smallest asset management company, we became the largest asset management company. Funds run by us were one of the best in India. Reliance Growth Fund, which I used to manage, by 2017 had become 100x. So the fund grew like 100x. A crore invested became 100 crores. I also did my CFA that time while I was working. Became the first president of the CFA India Society, also became the first Indian to sit on the global board of CFA. 2020, I also became the first Indian to sit on the Capital Market Advisory Committee of IFRS. I'm telling you this because other than the profession, I was also involved in a lot of other activities, and it helps. I was the president of Goregaon Sports Club, which is a sports club. I think these things, make you, I would say, a better person, apart from being a better professional. But anyway, 2017, after I had become the CIO-equities, I decided that all my life, I was always backing entrepreneurs. And here I was chickening out becoming an entrepreneur. And I should become an entrepreneur, spend the next the last 10, 15 years of my active professional life as an entrepreneur. And 2018, Abakkus was born. And I think it's been a fabulous journey, thanks to friends like you have supported us, thanks to our investors, and thanks to my team who have worked hard to generate returns. I think personally I like movies, and though I like even Hollywood movies, the charm is always in Bollywood. There cannot be better thing than Hollywood. And I also like sports, though I stopped playing cricket because I have a back issue. But sports have always fascinated me. I'm a part-time guitar player, also not very good, but I enjoy it. So it's pretty fine. I have a loving wife, 2 kids. One kid is in the US, 23-year-old, finished his MS in computer science, working with Amazon, and daughter who is right now with me because it's study from home. So that's about it.
No, that's superb, Sunil. It's great to hear about your family. And I've known you for such a long time. And till today, till my team had not done the research about your family, I actually didn't know about your family. And it's so good that you have shared it. I think this is the first time on a public forum you have talked about your love for guitar, or your love for cricket, or your children, or your wife. So that's
no one asked me before, Sanjiv. No one asked me before.
No, yeah, so that's actually true. So for me, these talks are more about us as people also, because when you back a fund manager or you back somebody, you're backing a person. At the end of the day, active fund management is all about backing a person. Today we are living in a quant world. There are a lot of quant funds coming, there are a lot of index funds there, and I will get into this question with you because this is a major competition that is coming up to human fund managers. But one of the things I've taken away, and which is something my father also taught me, that success in life is 99% hard work and 1% luck. And people say that 1% luck we can't see, but he always used to tell me, you can see that 1% luck. That is the ability to work for the right companies. So if I look at your life, as you said, that you joined a stockbroker because he wanted a smart boy who could pass the exam. That was the first level of luck. Second level of luck is when you move to an institutional brokerage, which taught you research, trying to do investment. And for me, that was also my background. My first job was on an institutional brokerage where we were doing research and trying to understand the stock. I shared this story last time.
Right.
So I was doing a cement industry analysis. So they told me that, we want you to go and visit the cement plants. And I was very excited. I said, yeah, sure. What I didn't realize was that all the cement plants are bloody middle of nowhere. And at the end of the day, at that time, there were no hotels. So you had to go and stay in a bloody shady guest house with so many mosquitoes. And, it was a really scary experience, but it was also a very exciting experience where you went in and you saw the industries, you saw the processes, you tried to take a call on winners. And when somebody backs you by putting their money behind you, that gives you a lot of responsibility. So, and then you chose Reliance, although that was a baby, but you believed in them. You believed that would give you a right platform. So, there are a lot of people who had asked this question, how do I build a right career? So guys, for you, I want to say, choosing the right organization is very, very important. Because if you don't choose a right organization, you will not get the right results. You need an organization which will give you the ability to flourish. It will give you the ability to grow. And then also take the second cue you have to take from Sunil is that don't live in your organization, live in the industry. So like he did the CFA, he was a part of the industry bodies. Live in this thing. Today we have a brand called I would like all of you to be active. And even I've started this very late, where I've started being active on my Twitter account maybe 3 months back. I've started being active on my LinkedIn about 1.5, 2 months back. But I truly believe that it helps people understand and see you as a human being. What do you believe in? What do you stand for? And this is something that all of us have to do this. So, there are a lot of interesting questions also coming in, although Sunil, I had decided to take the questions later. But let's take up a couple of questions. There is a gentleman asking that I want to start my investment journey. How do I start my investment journey? I know it's a very basic question, but it's also a very difficult question. And because, a lot of people just keep waiting on the side. So, how do they start their investment journey? What would you like to say, Sunil, on that?
So, a lot of experts have said that the best time to start investing is today. So, first of all, when you are looking at an investment, don't wait. You have to start immediately. Second is, I always say this, that, if you're an equity investor investing in India, you have to have confidence that India will grow. And, that is, I would say, 100% work done. You don't have to bother about anything else. Because this near-term, roadblocks, challenges will keep on coming. But if you're clear that you want to start investing today, and your equity and your investment is in an instrument where you have confidence from a 20, 30 years perspective, you can't go wrong. Third is have goals. And I'm talking about from a retail investor's perspective. You have to have goals, that what is this investment for? Whether it is for 1 year, whether it is for 5 years, it is for 10 years and 20 years. I think once you have that goal, that this is for my child's education, this is for some house I want to buy, or this is for my retirement, then again you will be able to have a longer period of time, and also put the amount which will get you to the goal. But the basic thing would be, don't wait for your investment to start. Today is the best time to start.
Yeah, so that's very, very well said. That, if you keep waiting in the line, you're not going to win the race. Till you have to start, running the race. And don't look at the absolute market. So, Sunil, before we get into the market, we had created a creative to show the journey of this market. So, I'll request our backend team, Abhin, please, if you can play that shows the growth of the Indian stock market, because there is a very interesting question I want to ask after that. Yeah, so if you look at it, you look at that graph. The reason I wanted to show you that there were a lot of points and there were a lot of places where people said, now this is it. Market is overvalued. It will not go beyond this. This is enough. This is the maximum that it will go to. But if you keep seeing, the market has kept on going up, it has kept on giving returns, and the people who have been sitting on the sidelines, or people who got scared because they were definitely falls in the middle also, have actually got left behind. So guys, one is that don't get left behind. And now comes my interesting question, Sunil. India has seen a tremendous growth in the last 70 years. And in 2019, you made a very interesting comment, which has actually got stuck on my mind, that in the next 10 years, we'll see more wealth creation happening in India in the next 10 years than we have seen in the last 70 years. Now, wow, that's something huge. Do you still believe in it? And why don't you just tell us about it? And I would like to understand more about it. I'm sure every investor here would want to understand that, is the next 10 years going to be huge value creation in India? How do we ride that journey? And how do we make the best out of it?
So, one on a lighter note, Sanjeev, we always try to find reasons why other investors have made it big and we have not been able to make it big. So, I come across investors, he says, 90s was a great time to invest. I wish I was there. And then some investors say, oh, dot-com time, it was the best time to make money and now we are left behind. But anyway, coming to this, 1947 is when India got its independence. From 1947 to 2007, which is a period of 60 years, we reached $1 trillion in economy. So it took us 60 years to reach $1 trillion in economy. The next 1 trillion to 2 trillion took us only 8 years. So by 2015, we were at $2 trillion. So, what took us 60 years, the same we were able to achieve in the next 8 years. As we speak, we are just over, after 70 years of independence, over $2.5 trillion in economy size. Even if we are able to grow at 10% per annum in nominal terms, if you grow at 7% real, at 3% inflation, 10% in nominal terms, we will be $5 trillion in the next 10 years. So basically, the wealth which you have created in 70 to 73 years since independence, the same amount of wealth is going to be created in the next 10 years. Now, if you are an optimist, you would say, no, it will be in 8 years. If you are a pessimist, you will say it will be in 12 years. Doesn't matter. I think the fact of the matter is that what has been created as a country in the last 70 to 73 years, the same amount of wealth is going to be created over the next 10 to 12 years. And I think that is what any investor should keep in mind. I think there is no doubt in anyone's mind that this will happen. Doubt can be in 1 or 2 years here and there. And I think that is what the opportunity is. And again, I'm, at least there is a disclaimer that I've always been positive, but that positiveness has helped me. By being positive, I've ensured that I don't get hassled by all the red dots which you saw, which was a scam and which was Lehman Brothers and which was COVID. And you continued, and then you got the benefit of all the huge bars and the yellow dots which you got. But I think India is slated to grow at least 7%, and that would, it's a mathematic. You will make as much money in the next 10 what you made in the last 70.
So India is actually seeing a power of compounding. We on investments, we talk about power of compounding. So as a nation also, we are seeing the power of compounding, that whatever good work has happened. So just, Sunil, there are a lot of fresh investors here. Why don't you tell them about compounding? And, your example of Indian economy told about the power of compounding. But, as an investor, being in this market for the long run, a lot of people have said, look, I've heard about Warren Buffett. I've heard about him. I'm never going to be as rich. But, but you can always be a great stock picker, and there will always be a new Warren Buffett. There'll always be next generation. So just inspire them, telling them about the power of compounding and what is possible, provided you start doing this and you keep doing this for the next 30, 40 years.
No, I think, the biggest impact of compounding is felt after a few years. So, it's very simple to say, investors come. Unfortunately, equity investors expect 50% return every year. And I jokingly say that your money is lying in a fixed income, it's making 4.5% or sad raha hai, but we don't mind it. But here we want to make double our money every month, which is not going to happen. But very simple, even if you are able to invest logically, like Reliance Growth Fund when we used to manage, it gave a compounding return of 22%, but that made it 100x in 20 years. So 100x in 20 years, people will say, wow, but it is 21, 22% compounding return. If you grow your money at 18%, you double every 4 years. So in 20 years, it will be like 2 raised to 5, which will be 32 times. And I think that is what compounding is all about. The other thing is, even Warren Buffett after 20, 30 years, because of the compounding effect. If you see his returns, they have been like 20%, 12%, 10%. It's not like he's made 100% return 5-6 years. It's been bits and pieces, and it just got compounded and compounding. And I think that is where you are. So I think from a retail investor's perspective, one is we cannot go from zero to Warren Buffett in 1 year. But we have to start somewhere. And I think I don't think every one of us can be Warren Buffett, but we all can do justice and have a second source of income, which is through our investment. So one source of our income is our daily job. I think the second source of our income should be the investments which we make. And I think over a period of time, the second source of your income would be much higher than your primary source of income because of the power of compounding.
Very well said, this thing. So there is a question by Vivek. Thank you for this interesting, creative. So, I have to give kudos to the team. We were talking about Warren Buffett, and they've shown how his wealth has grown. And this whole chart shows the power of compounding. That even Warren Buffett wasn't built in a day, but but if you remain invested and you keep invested and you keep on top of your investments, then one day your second income is going to become bigger than your first income. And you have to, guys, this is also very, very important for everyone. Like, we just invest in our business or our job. We have to understand all sources of income have their ups and downs. So like jobs, we saw COVID, it happened. A lot of people took salary cuts. Some people even lost their jobs. And some people were absolutely fine and some people made money. So point is that there will always be ups and downs in life, but you must have a second income. You must have a second source of earning, and that is your investments. And investments need to be looked at as a business. So that is why I say, look, you do any business, like you have to do your CA, CFA, whatever. You have to also learn investing. Please don't make that mistake of just jumping in. So if you are good enough, you can do a CFA, please do CFA. There is a question, Sunil, I would like to answer that. Who should do a CFA? Does it make sense for a CA to do a CFA? So please do answer that. But but at the same time, what I would like to say, basic fundamental knowledge of investing in a structured manner rather than just reading from here and there is very, very important, and which we need to have. So, maybe this is the last general question, and then we get into more, investment centered question. So just tell us about CFA, CFP, what do you feel, how important it is, and, or a basic investment program that people should do. So, what do you feel about that?
Sure. So, one is, again, my view would be biased because I'm a chartered accountant, but I would say that there is no course like a CA anywhere in the world. And it's the most cost effective designation to have. It enables you to have 3-4 years of actual practical training because when you're doing articleship, you actually work. I don't think any course in the world will have that kind of a rigor. And it basically ensures that your foundation is very strong. And once your foundation is very strong, everything else is an add-on. Now, coming to CFA, CFA by the very name is Chartered Financial Analyst. So a chartered accountant is basically more, trained to know about the accounts, know about the acts, know about company law. I think Chartered Financial Analyst is one step ahead, where you are taught to analyze the accounting statements. So a chartered accountant makes the accounting statements. A chartered financial analyst is taught how to analyze the accounting statements. And I think if you are interested in anything to do with investment banking, with research analyst, being a fund manager, being a portfolio manager, I think CFA would be a good add-on. CFP, again, by the very nature, is Chartered Financial Planning. So I would say that, Chartered Financial Planning will have a little bit of a different characteristic, because it will obviously need you to know more about investments, but it would be more about a very holistic view about planning, about risk management, about goal setting. So I think if you intend to be like a financial planner or a IFA, independent financial advisor, or a wealth manager or a relationship manager, maybe CFP is for you. If you intend to be an analyst or a portfolio manager, the CFA is a great add-on. But I would say there is no better designation than CA, because it really strengthens your foundation.
Yeah. So there is also a very interesting question by a person that how do I lose the risk of losing money in stock market? So then that is a lot of people, I have a very firm view there, but I would first like you to answer. Then I will like to come in and, just put in my own views on that.
So one is taking my interest in Bollywood and everything. I would start with the dialogue of scam, risk hai to ishq hai. Unless there is risk, there is no return. And risk doesn't mean that you are playing a lottery. Risk is a calculated or a understood kind of a phenomena which you will have to take to generate returns. And the other thing is, in equity market, if you are diligent, if you are focused on good stocks, on good investments, then risk can be equated to volatility. A lot of times we believe that volatility is risk. Volatility is not risk. You buy a stock at 100 rupees, it goes down to 90. If you are confident that 100 is going to become 200 in 4 or 5 years. But because that 100 has gone to 90, we think that it is risky. It is not risky, it is volatile. So I think unless you have, I would say, the patience and courage to see a mark-to-market loss in the near term, you cannot and you shouldn't be an equity investor, because you will make all the wrong decisions. You will get scared at the wrong time and you will get greedy at the wrong time. But you should be prepared for a 15-20% drawdown whenever you are an equity investor. But just again to repeat, volatility is not risk. Risk is buying something which you don't understand. Some hot IPO comes in and you buy it just because some great name has bought it, or some friend has recommended it, or you get a tip. मैं बोलता हूँ ले लो ये 4 दिन में double हो जाएगा. I think that is risk. That is not volatility, that is risk. So one has to be very clear between the distinction between risk and volatility. But if you can't bear the thought of a small mark-to-market loss, you should not be in equity markets.
Yeah, and plus, I like to say that, look, as Sunil very rightly said, equities are not risky. It is investing without knowing why you're investing is what is risky about it. Yeah. So if you invest in a company which is overhyped, or it is over pumped up, or it is a penny stock, that's where you have a chances of losing money. But if you're invested in a blue chip stock, and if you're risk averse, today you can invest in one of the largest stocks in the world. Now that company may come down by 10, 15, 20 or even 30%, but it's not going to go anywhere. And eventually it's going to bounce back. It is going to be growing. So it is only when you get into the small cap, mid cap or micro caps, that's where you have to be careful. And that's where you need to depend on good fund managers. And you need to choose good mutual funds or PMSs, and stop being penny wise, pound foolish. Okay, look, I want to be a direct investor, or I want to be an indirect investor. I'm being smart. I'm saving 0.5%. No. If you have the right advisor, you have to pay him. So point is that, yes, one, you have to find a person who you feel is worth paying for. And that is the person who keeps you on your journey. He is the person who does the research for you. He's working at you at a fraction of a cost on a pure variable basis. And you have the right to fire him anytime. But then he's the one who's going to add value to you. So guys, it is very, very important to choose the right partner with you on this journey, and then take a decision basis on your risk. If you are a risky person, then you can probably do small cap, mid cap, and even there I would invest, go through a funds, go through a lot of diligence, or be very careful of your pick. But when you're picking up a blue chip or a great or a large stocks, today 85% of India's profits are made by 10 to 15 companies. So if you're investing in those companies are not going anywhere. They're going to grow, and you're going to grow along with them. So Sunil, also now the next question is, in that given that the market has risen so much in the last 1 year, people are concerned about the next 10 years. What kind of returns can they expect from stock market in the next 10 years? And if they were to invest in Abakkus, what kind of returns should they expect?
So one is, I have worked in mutual fund for a long time, and therefore I have by hearted that saying, past returns are not an indication of future returns. So that is a disclaimer. See, I think how do we get returns from equity markets? It is basically growth in profit. So if a company's profit grows by 15%, logically the return would be 15%. Yes, in the near term, your PE multiple might contract or expand, and therefore in the near term, the return might not mimic exactly that. But ultimately, over a period of time, the economy size and the market will go hand in hand. So if today we have almost $3 trillion of economy, our market cap is also almost 3 trillion. So it is said that 1:1 is a good ratio. In hype, it goes above that. In bearish times, it falls to even 60% of that. Now look at the economy. We have been growing at the rate of 7.5% for the last 10 years. Yes, last 2-3 years have been disappointing because we had demon, and then we had GST impact, and then before we recovered, we had this COVID impact. But it is logical to basically forecast that India would grow at least 6.5-7%. There is a possibility that we might go even faster because last 7-8 months the government has been a very transformed government. We have been taking a lot of steps which are going to push the economic growth. And as I said, if you add even 3% inflation, you are going to grow as an economy at 10% on a nominal basis. Now add 2-3% from corporates by way of efficiencies or by way of portfolio selection, you have profit growth of good corporates at anywhere between 12 to 14%. And our view is that that kind of returns we can expect from the equity markets over a period of time. Obviously, if you are in very large companies, the growth rate or the return expectations might be lower. We believe that large caps over a period of 5 to 10 years can give you anywhere between 8 to 10% return. But the broader market, which is where the growth can be faster, the new sectors are coming up, the faster growing sectors are coming up, and where there is underinvestment, those can grow anywhere between 13-14% to even 17-18%. And I think at Abakkus, what we try to do is focus on companies where profits can double at least in 5 years. And that is basically our expectation, is that if profits double in 5 years, there is no reason for us to believe that the returns will also be double in 5 years. So that is the aim, and that is the target which we work with.
So Sunil, how do you go about doing your research? Is it only theoretical, sitting there, or do you go and meet the companies? So how do you go about selecting the companies that are going to be a part of your Abakkus portfolio?
So one is, what I have learned is that India is a country with a lot of entrepreneurs, a lot of listed companies. We have almost 2,500 companies which are traded regularly, almost 1,000 companies which can be investable at different points of time. We have exposure to almost all sectors. So, unlike Brazil, which is maybe only oil and gas or only commodities, or China, which is predominantly public sector, or Russia, which is only oil and gas, India has everything. We have oil and gas, we have metals, we have manufacturing, we have services, we have banking, we have IT, and everything. And I think that basically means that there are more opportunities, but at the same time, we have to do more work also. So the first thing is that the large broking companies will only have 70-80 companies under their research. If you want to do more companies and look at more companies, you have to have a very strong in-house team. So the first thing which we did at Abakkus was to create a very strong team. At this point of time, we have 11 members on the investment side. We track almost 350 companies on our own. Second is, experience counts. So between our team and between myself, we have almost 110 years of researching Indian companies. And again, luckily, because I've been in this field for like 25 years, I have met almost all the promoters at some point of time. So there is already a history. What we do is we have a 5D process. So, one is the discovery mechanism. Discovery can be multiple ways. You keep on meeting companies in conferences, one-on-one, you have history, you have some sector view, and you also do some, screeners on the basis of which, like, 6 months back, we ran a screener. Companies which had done capex, but that capex had not come into commercial production. So the moment that capex comes into commercial production, you will have a big jump in P&L, and you can have a big jump in profit. Or, we did a screener where companies which had the largest payouts of interest. And if interest rates were to fall sharply, these were the companies where there will be a big jump in profitability. And then, you delve deeper into it. Meeting the company is a must. Unfortunately, in this COVID time, that meetings have become virtual meetings. We are missing factory visits, frankly. My view is that when you go, see, when a CEO or CFO comes to your office, they have a ready-made presentation. They know what to talk. When you visit the company, they are not there with the ready-made presentation. So I think that discussion becomes more fruitful. When you go to a factory, the guy who's working in the factory as a worker, the supervisor, the factory manager has no interest in market cap or nothing. They give you the facts. A CEO and CFO will tell you what you like to hear. They know. A factory manager will give you the facts. When you go in a factory, there are boards where the production numbers are there. You actually see trucks. You can make out. It's a big factory. Truck aa raha hai, ja raha hai. Raw material is there. Finished good is there. You see the boxes. So it's a very, very different kind of a thing. And I think all this we have learned by making mistakes, by losing money, and by experience. I think the best way of learning, apart from your courses, is to make losses. And that would be the biggest fees, because you learn from experience. So I think it's fun. The good thing about our profession, Sanjiv, is that you learn every day. You make mistakes every day, you learn every day. But one rule which we have is you cannot make the same mistake again. रोज नया mistake करो बस कोई problem नहीं. You can't repeat the mistake because every mistake costs money. And other thing is it's very dynamic. Sectors which were great yesterday might not survive today. You see multiplexes. They were full before COVID. And now it's hope. And we have all got used to watching movies on Netflix and Amazon of the world. Suddenly the business model has changed. Or even, logically, if I had to meet Sanjiv Bajaj, I had to travel to Delhi, take a morning flight, meet, stay in Delhi, come the next day. It was a 1 lakh rupee cost for me. Now the airlines are suffering, the hotels are suffering. We are meeting virtually. So earlier we had this option, but we had not made up our mind to use it. Now this compulsion has become a habit. We now know that it is used to it. Or even electric vehicles. I always say this. If electric vehicles were to become mainstream, and they will become mainstream. I'll give you an example. We used to have TVs which was like this huge. We had picture tubes and all. Suddenly in 2-3 years, picture tubes vanished. Makers of picture tubes just vanished. I think if electric vehicles were to become mainstream, what will happen to the engine manufacturers? I'm telling you what will happen to the carburetor manufacturer or the exhaust system manufacturer? There is no smoke. You don't need a carburetor in an electric vehicle. So I think, this is very interesting. And I think that is where in-house research, a good team, experienced team, on the ground and reading and analyzing becomes very important.
Very well said, Sunil. Very, very well said. So there is a question, very interesting question by Mr. Harijan Das. He's asking, which is again a basic question, but he's asking, can you suggest saving monthly income that people are facing? I'm assuming he may be a retiree or he's talking on behalf of retirees with the deterioration of the bank and the NBFC's housing interest rates. So in the interest rates in Indian economies are following. So people who are just investing in debt, they are looking at their returns falling. And, although this recent decision, the small saving interest rates was taken back, but all of us know that was due to the West Bengal and Assam election. But the whole future is clear that the interest rates will fall in India. So in a falling interest rate, a person who's dependent on fixed income or who's dependent on interest for his livelihood, what does he do?
So I think I really, sympathize with the aged population of our country, largely because we don't have a very systematic, old age pension scheme like a lot of other countries have. There are some schemes, but by and large, old Indians are left to fend for themselves and depend on their savings. I remember earlier, people used to say that, if you have 1 crore rupees in saving, then you will be assured of 1 lakh rupees a month as monthly income. And that was the yardstick. Now that 1 lakh has become 50,000. And on the other end, the costs, which maybe were 50,000 at that point of time per month, have become 1 lakh. So, it's a very, very serious kind of an issue, particularly for the retirees who don't have, children who can take care of them. I think it's a serious thing. Having said that, it highlights a lot of things for people who are still working and will retire at some point of time. So we should learn from them and start having a diversified portfolio which also has some growth assets like equity, so that when they retire, they have a bigger pool, because you will require a much bigger pool when you retire, as the interest rates are only going to fall. For people who already have retired, I think things are going to be very tough. But I can only suggest that, don't put everything in equity markets just because you need higher income, because, you also need regular income. So I think based on your age, you will have to take the help of your financial planner and have maybe a 20-25% exposure to equity, 75% maybe would be still with fixed income because you need a monthly kind of a thing, and try to see, or make a plan where at least your annual return can be at least 9-10%. That would be my suggestion.
Yeah. So Sunil, I fully agree with you because, I think anybody who's looking at a career, if you can't do CA or CFA, please become a CFP, because I think the future for planners is very, very good. And I see the work being done by International College of Financial Planning, 85% pass rate. So whether it is due to the lockdown and the cheating in the lockdown, but we have never seen this type of pass rates, or it is an amazing work. So sorry, I don't want to be questioned by them. Maybe they're doing an amazing work in teaching and 85% people are clearing. So please do this, because advisors are going to be the future, and especially in the falling interest rate. And for the senior citizen, look guys, you may be at 60, 65 or even 70, but still you are going to need your money over 10, 15, 20 years. So keeping all your money in debt is also not a good option. So I feel that even if you are above 60 or 65, keep a part of your allocation in equity, because part of this money needs to last 15 years, 20 years. And that is good enough for time for you to have. So, but maybe you can choose to be more conservative. You can choose to be in the top Nifty 50 stocks, or even a more concentrated portfolio of blue chip stocks where you have lesser volatility and maybe a little lesser growth. But so you always, even if you are above 60 today, equity needs to be part of every portfolio. Also, there are a lot of these good schemes by now insurance company which are called annuity plans. So these are immediate annuity plans. They are not insurance. So since they come from insurance, people get confused and they get lost. These are annuity plans which are aimed to give you a X amount of income, which is 7.5%, 8% income over the next 15 years, 20 years. So you can evaluate them and make them as a part of your portfolio, because you're assured of that income coming in for 15 to 20 years. Another things which I recommend to a lot of clients today, you have, if you're less than 70, then you have term plans, which give you protection up to the age of 99, which are almost like a family legacy plan. So you don't have to keep all your investments and save your investments. I want to give it to my children, I want to give it to my grandchildren. You can actually buy a life insurance for your children and your grandchildren to give the legacy you wanted to give them, and you can use the money to live a better life for yourself. Now, this is something I have recommended to even very close of people in my own family, that look, buy an insurance if you can get it. And today cost is quite reasonable, quite low, given the competitive. It has gone up due to COVID, but still it is quite reasonable. And at least it frees up your capital to be spent on you. And you are still able to give that legacy. जो हमारा Indian method mindset होता है ना, I want to leave something for my next generation. It is amazing. So, and you can do that, and at the same time, you can achieve it. So now, Sunil, next question is, there is a Bharat Bhai. He's asking a question that what is the next story? Is it chemical, pharma, or infra? How would you like to take that and answer that?
No, so, frankly, one is on a lighter note, again, all investors want to know the next story. Though they have missed all the past stories, because they are always looking at stories. So frankly, when you are investing, have a diversified portfolio. Don't get sucked into stories, because that might work or not work. So, whatever I say might work or not work. So take it with a pinch of salt. But I do believe that the way we are living today, and more so post-COVID last 1 year, the way we are working, the way we are studying, the way we are consuming, the way we are shopping, the way we are entertaining ourselves, I think it's very clear that digital is going to be a part of our life. We have an investment in a company which is into music. I remember when I was young, we used to have cassettes. And if Sanjiv was my friend and Sanjiv had 20 cassettes, what I used to do was borrow from him and record it and consume music. Then we had CDs, and then we had so on and so forth. Now we are consuming even music on digital platform. We don't need to go to a shop. We are buying everything on digital platform. We are watching each other on digital platform. We are entertaining ourselves on digital platform. Everything is turned digital. I think stocks are expensive. Unfortunately, in India, we are too liberalized. People complain that we need more liberalization. I think we are too liberalized. We missed out investing in Flipkart and Ola and Byju's of the world, because we were too liberalized. You see Chinese investors, they have been able to invest in Alibaba and Tencent and so on and so forth. Anyway, doesn't matter. There will be a lot of opportunities to come up. Some of these companies, when they come up for listing, might be expensive. I don't know. But, whenever you get an opportunity to buy directly or indirectly, good, long-lasting digital plays which have a great business model and which you yourself are using it, I think you will definitely make returns. And one thing which is a little bit away from this, Sanjeev, is that I have seen that the best investments are investments which are very logical. So when you started opening an account in an HDFC bank, you knew that this bank is going to gain market share. Or when you started ordering pizza, you knew that Jubilant Foodworks is going to have a great year. Or so on and so forth. I think a lot of these investments are very logical. I'll just give a small example. I've mentioned it earlier. 1997 is when my son was born. I was a very small, ordinary guy, and he was born in a big hospital, and the doctor gave me a chit that I need these 3 injections. And at that time, hepatitis B was very prevalent, and I went with 100 rupees in my pocket to a pharmacy. 3 injection dena, and he said 10,500. I got the shock of my life, So I went next day, because I did not have money that time, and there was no credit cards and all which was used that time. I paid him 10,500. I saw on the bottle it was made by SKF, which became Glaxopharma. I said, if every kid has to be given this 10,500 rupees injection, you better buy the stock. So I bought 100 shares only, because that was the only money I had, and my whole hospitalization cost I recovered in 3 months. So a lot of these trends which you see for the future, you can actually experience yourself. You don't need anyone. It's all basic. It was just off the topic, but I would say that digital still has a long way to go as far as India is concerned.
Very well said. When you start investing in stocks or mutual funds, and you should see even in mutual funds, what are the underlying stocks, or even a PMS, what are the underlying stocks you are investing in? And then start learning about companies. So when you come across their products, you can see how they're doing. or at least for all of us who are regular investors, we also are very observant what is happening in the market. A lot of the stocks I buy, or I do a lot of startup investing, and and the whole journey for me starts like I look at a startup, I enjoy their product, and I reach out to them. Okay, look, guys, I want to buy stocks in you, or I want to buy a share in you because I like what you're doing. The other day, I saw somebody who's done a fantastic job, and he had closed his seed funding, and he's now in going for the next round. I said, I want to be a part of your journey, and I will help you in this journey, but I want to be a part because I really like the product and I really like the delivery. So so point is that it, I think, opens up a lot of this thing. There's an amazing question by Kamesh, which is Rane, which is how to deal with or invest in the growth stocks. Now, this growth versus value question has been going on for some time. So, Sunil, if you can answer that.
Sure. No, I think it is very interesting. But, Sanjeev, I would say that investors and prospective investors misunderstand the definition of growth. What is growth? A growth stock would be something which grows significantly higher than the economy. At least I presume that would be the definition of growth. I don't think every FMCG company or every IT company or every pharma company will be a growth stock. So my perspective is, and we have written a note which was very well read, though it was a little controversial, which was titled Bubble in Quality. A company which is growing at 10% per annum cannot be trading at ATP. Bottom line. And I don't subscribe to the theory that buy quality at any price, you'll always make money. I think there will be phases of 5, 10, 15 years where you will end up making no money. We had that scenario in the US where it was, I think the Super 50 stocks, which they used to call it, in mid-70s. We had it in India where Hindustan Lever gave no return for 10 years. We are having this now in ITC, which has given no return for the last 5, 6 years. So I think you buy quality, you pay a price which justifies the future cash flows you're going to get from that company. So when we wrote the note in October 2019, the market cap of Nestle and Hindustan Lever put together was 6.5 lakh crores. And they were making 7,000 crores in profits. The market cap of all steel, metal, cement, and building material companies put together was only 75,000 crores. And they were also making 7,000 crores of profit. And in the last 13, 14 months, this 7.5 lakh crores of Nestle and Hindustan Lever has stayed there. That 75,000 crores has become 2 lakh crores. So it's not that I'm trying to praise ourselves. What I'm trying to say is that there is a price for every stock and every asset class. You cannot buy a 10% growth company at ATP multiple, and you cannot have a 15, 18% compounding stock trading at 5 multiple. And I think that is what at least our view is,
Yeah, so very well answered, Sunil. This also answers a lot of questions that people are asking, like Pankaj Ghakar is asking a question, do I invest in mutual funds, PMS or direct? Now, this is a question that comes, and I think what Sunil has answered comes automatically. See, a value of a qualified professional is immense. So even if you are paying half of 1% for them, that's my belief. It's a great value that you are getting. A good advisor is a very important part of the journey. It is all a fallacy. Okay, today you have these apps which says that you will save 30 lakh rupees in the next 20 years, provided you don't go with your advisor. Please understand, will you remain invested in the right stocks for those 30 years or not, or 20 years or not? Who's there when there is going to be the next crash to tell you, hey, look, guys, don't worry. Or whenever you have any question, or when something like the Templeton issue that was happening, or there is any news which is coming out in the market. So you need to have somebody who you can discuss these things with. It is very, very important. So I will also, Sunil, like you to answer, mutual funds, PMS versus direct. What do you feel about that?
So see, I think direct is something which is very tough. I would just give you a perspective that if you're investing in a mutual fund or a PMS structure, you are giving your money to professionals whose only work from morning to evening is managing that money. They have resources in terms of a team. They have resources in terms of the constant interaction they have with multiple analysts on the sell side. They have resources of reaching out to companies, attending analyst meets, and so on and so forth. And they also have the resources, because it's a full-time work for them, to be tracking what is happening globally. I think if you are an equity investor, an individual equity investor, unless you are sure about you being able to do all this, I think you will end up a lot of times on the wrong side. As far as mutual funds and PMS is concerned, frankly, it's up to the investor. Mutual funds are great instruments. I have seen mutual funds very closely, having worked in that industry for 15 years. It has great tax benefits, great ease of getting in and getting out, though I would say that you should not get out, but still there is an ease, very simple product to understand, and very, very good, by and large, professional, portfolio managers. PMS and AIF, obviously, you need to be a high net worth individual because of the minimum restrictions. It adds to your returns, but obviously, you also have to have a clear perspective on the person who is going to manage your money and the method in which the money is being managed. Because you don't want to have a scenario where in good markets you do well, but in challenging markets, which is what we saw between 2007 to 2020, you end up losing 50-60%. So I would say for retail investors, nothing better than mutual fund. For an HNI, maybe a mix of PMS/AIF and mutual funds. But at the same time, please take advice of a financial planner, because a financial planner will understand your risk appetite and also your horizon of investment, and will be able to guide you much better in terms of a long-term wealth creation planning.
Yeah, and let me say that the questions are fantastic. And Sunil, I can go. We are above above time, but I'm very amazed by the quality of people who have come in today and asking the questions, because the quality of questions are simply phenomenal. So thank you guys for taking out time and being here. But we can only do one question. So that question I'll pick up is on the global liquidity. That there is a lot of talk about this global liquidity pushing up the stock markets. What do you feel about it? And how do we identify when this liquidity is moving out? So what are the right indicators for it? And finally, about Abakkus PMS, what's your fund? How does a person invest in it? People have this question. 50 lakhs is a huge entry barrier. So is there a way that you can do, limited call where a person can commit 50 lakhs but come over 1 year, or any other innovative way of getting in? So, if you can answer a little bit of those questions, Sunil.
So one is on the liquidity front. Yes, there is absolutely no doubt that central banks across the world have printed a lot of money, has pumped in a lot of money, and we are seeing that. Hindi mein कहते हैं कि 90% of your problems get sorted by money. So I think central banks have followed that and they have pumped in a lot of money. Now, when it is going to be sucked out, I think it's $1 million question. But we have the last crisis, which was Lehman crisis, as an example before us. So, Lehman crisis also, central banks across the world pumped in a lot of money. US also printed a lot of money. It took them almost 11, 12 years to slowly, bring it back to normal. Unfortunately, COVID happened and they had to start the cycle again. There is absolutely clarity in our mind that this period of ample liquidities continue at least for the next 3-4 years, because the world is still grappling with constant lockdown, opening up, things being not normal. And therefore, no central banks can afford to tighten it immediately. However, let me just add one thing here. We always get paranoid. There was this term called taper tantrum. Every 3 months, we learn a new term. Even I was not knowing the full meaning till I Googled it. And I'm very sure most of you would have done it. I think this taper tantrum does not work. And in fact, if you go back between 2003 to 2008, which was the biggest bull run of all times globally, I'm not talking about India, globally, interest rates in US, in fact, went up from 2.5% to 6.5% in that time frame, and the markets kept on going up. So one factor is not going to decide whether the markets are going to go up or go down over a period of time. Okay, on a day-to-day basis, You might take a call, 1.7% हो गया, बेच दो, 1.6% हो गया, ले लो. But over the medium and long term, one factor is not going to impact that much. Only thing I can say is that be very clear in your asset allocation. If you are advised to put 40-50% of your wealth in equity, don't make it 150%. Don't borrow and invest because you want to become Warren Buffett the next day. I think that is a catastrophe. As far as Abakkus is concerned, we are a small outfit. We have two AIFs, which we unfortunately are shut. We have a PMS where regulations basically have 50 lakhs as the minimum thing. There is an option of systematic investment plan, but the regulation says that first you have to have 50 lakhs, and then you can keep on topping up with small thing. Let us see. I think whenever we find an opportunity where we can, bring something in front of you with a lower, value to start with, we would be more than happy to do it. I can only tell you that the second innings of me is more towards, enjoying the process, towards following the passion, and towards ensuring that you remember me even after I'm not a portfolio manager.
Very well said, Sunil. So I know we are above time. So let me just give a couple of things. So guys, as I said, look, there are a lot of people who have questioned on the issues they have faced with some of their wealth managers. Yes, that's exactly there, and you have to be knowledgeable. Otherwise, if you are too naive, people will take you for a ride. So that's why we have created this fantastic program. You can check it out at befintastic.com. As I have said, our aim is not to make money. If you don't like it, what you're doing, first week you get 100% of your money back. There'll be no questions asked. So please do look at it. And Sunil, one last question. A lot of people who are saying don't have 50 lakhs at the moment, or who have 5 lakh rupees, they are asking, give them 5 stock tips. I think, and that's only fair. You're here. Tell them about 5 stocks that you feel are going to give a fantastic returns in the next 5 years. So at least let's add value to everybody's life. Even if they can't come into Abakkus or they can't afford a good wealth manager.
So I'm unfortunately constrained because I'm a regulated entity. And the first thing which we would like is full compliance. So I'm very, very sorry about it. What I can share is that, one, be positive on the country. If you are positive, you will always make returns. Second is deal and trust the best people. So do more research in identifying the people you want to work with, and do less research on the stocks, because that is what those people will be doing it. I think third is don't get overawed by day-to-day noise. I used to travel in local trains, and local train में 1 घंटा time pass करना पड़ता था, because I used to stay in Malad and I used to go all the way to Churchgate. So what do? You talk. The easiest thing to do is talk either Bollywood, politics, or stocks. And in local trains, everyone was an expert in stocks, because so get away from that tipbaji, because in the quest of making short-term money, you will end up losing. In also becoming too, I would say, fearful, you will end up losing the opportunity to buy. So in March last year, again, a little bit long answer, people said that, equities will not survive. There were experts on TV which said that 90% of the companies would not survive. And our answer was very clear. अगर आप जिंदा रहोगे, तो इक्विटी में पैसा बनेगा. और अगर आप जिंदा ही नहीं रहोगे, तो इक्विटी में के फिक्स्ड इनकम में क्या फर्क पड़ता है? Because COVID time, no one even knew whether you would be alive after 2 months. That was a kind of fear. So I think sometimes just be a little logical. In terms of stocks, unfortunately, I can't. But what I can say, our portfolios, at least to our investors, are available. You can see our holdings and take a call accordingly.
So thank you guys for being here today, and thank you, Sunil, for a fantastic talk. I'm sorry we were not able to take all the questions. There are a lot of questions on ETF and how to select the right ETF. I promise you we'll take this up. So fantastic talks are going to happen every alternate Tuesdays. So please do take this time to join. You're getting a chance to interact with some of the best brains in the industry, the best brains in India, and we are calling some of the best international brains also will be calling. So, learn from this. And at the end of the day, these are the type of people you want to hear, you want to follow, rather than the person you meet on the local train, or a person who's trying to push because he's got some stake in some, or he's trying to push up a penny stock. So please be very, very careful, invest in good companies, be cautious, learn, and to make the right steps, and wishing all of you a very wealthy future. So thank you, Sunil, and thank you everyone for joining the talk today. Thanks a lot. Bye.